Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's March 28th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Tell you, it's been a tough year for me thus far. Family-wise, tell you what happened to my wife. They found a lump in her breast. She's a breast cancer survivor. Told you guys to say some prayers. You did, and it worked. Turned out to be nothing. But the past 4 or 5 days have been difficult because we found out our youngest daughter had bad stomach problems. We brought her to the emergency room, and she's 7. And they just sent her back and saying, "Oh, yeah, it's not probably nothing." And I mean, she was in excruciating pain every time she went to the bathroom. And we said, okay, let's wait a couple of days. And I was actually out about 4 or 5 hour drive away for like 4 days. And it just got progressively worse. So we took her there again. And then they admitted her and they started asking about the family history. And my dad had colitis. So they were thinking that it could be colitis, it could be Crohn's disease. So yeah, she's been in the hospital for the past 4 days, a lot of pain and stuff like that. And then she basically just got diagnosed with, actually it's in the middle, if that makes sense. So they're not ready to call it either or, but it's one of them. So when it comes to colitis, it's basically lower large intestine, and Crohn's is pretty much small intestine as well. And they say that could be a little bit worse. That could require surgery. I have a friend that has surgery, and he's much better now and things like that, like later on. But this is something she's going to have for the rest of her life, and it comes in and out, and sometimes it's remission, and sometimes it get bad. So I've been getting a lot of feedback from people that had it, but it's been a pretty crazy period. I mean, last 4 or 5 days, kind of in and out of office, your head's in the clouds a little bit of what's going on. But now that we know, at least we can learn about it and, get a better perspective. But it's been tough, and it's, we're talking about like different drugs to use. We're going to get to that stage and diets and things like that. But I'm pretty sure that the insurance companies are not going to cover the drugs that she needs. Sometimes people will use drugs for a certain amount of time, and you could be in remission for 3, 4, 5 years, and then it comes really hard. So it's almost like, 3 steps forward, 2 steps back, and you keep going that way. It's, just something that you live with. It's tough. It's just she's so young, so it's, a difficult situation. But then when you go to the insurance companies, the doctor's like, well, we've even appealed a lot of this for people who have this, and they said more and more people, more and more kids are getting diagnosed now than ever with these diseases, which is interesting because they don't know what the cause is. They could be hereditary. They say it could be stress related or diets or what they eat and stuff. They're not too sure what it is. But the fact that it's increasing is kind of interesting, right? Usually we see some of these diseases where there's so many things coming out, new technologies. We're hoping that a lot of these things that have been around for so long, percentages are decreasing. So when you look at that part with the insurance companies, it's really interesting because the cost of these is crazy expensive. And the insurance companies now today, it's terrible. We use U.S. healthcare, and they're horrible, just like everybody else. You pay a fortune for insurance, and they really do everything they can not to pay you when you're paying for this in case things like this happen. And for example, my back has been hurting a ton lately. I know it's like something more than just a little pain. It's been hurting for about 2-3 months, and I have one of the best back doctors around, and I had 2 surgeries on it. And I know it's something more, and I just want to make sure and say, okay, what's the deal? Because they say once you have one surgery, you're going to have more. So my doctor's like, okay, we need an MRI to see what's going on. So he ordered the MRI, and they denied it. He said, no, well, we don't think you need an MRI. You know, I had 2 back surgeries. So you look at insurance companies right now, it gets to the point where you're looking at Jamie Dimon, Jeff Bezos. I mean, they're trying to, just provide a better, not disrupt the industry so they make profits, but the whole industry is completely broke. Because I'm thinking, hey, okay, I have money to afford this. Okay, I have my own business. And it's not like I'm filthy rich and have 20 boats or anything. But what about the family that makes $30,000, $40,000 a year? I mean, the average income is what these days in the U.S., like $40,000, $50,000. They have insurance companies that are refusing to pay for some of this stuff. It gets pretty crazy when you think about it. And something that should be covered, it's not. We got to take something that may not be the best drug for her. And again, we don't even know it too much. I'm learning about this situation. Again, this is all new. I just came back from the hospital. It was interesting because my wife slept there for the first, I think it's 4 days. So she didn't have 5 days. Now she's going to be in there probably for 7. And she was in excruciating pain, getting up like every hour, screaming. I mean, it was crazy. I think The Exorcist, except not that deep voice. It was insane. I felt terrible for her. So my wife got no sleep. I said, look, I'm going to sleep at the hospital. All right, I'll take it. I slept at the hospital last night. So I'm doing this on Wednesday. And they finally diagnosed her. So they basically said it's either or. They're leaning a little bit more towards Crohn's, but a lot of times we're really not too sure until later on. Either way, you got to use the same medicine for now, which is steroids, which basically kills it for now. So she took the steroids yesterday and they started kicking in and she's getting a lot better. So I said, yeah, I'll sleep there. And I'm averaging probably about 2 hours sleep maybe in the past 4 or 5 days with all this going on. So, of course, I kicked in and we both slept for like 10, 12 hours. So, my wife went there. How was everything? Was she okay? I couldn't tell her we slept for 12 hours, right? You never tell your wife that ever. It's like you going away on a trip with your friends and she has the kids and you come back and say, oh, it was so great. We did so many great things. You have no idea. No. That's a no-no. You never, ever, ever, ever say that ever. You say, oh, I missed you. It wasn't that good. That's the better thing. So I was kind of like, nah, it wasn't that good. And in the meantime, I was very, very happy that she slept. And I just told my wife, I was like, no, it was pretty good. And we slept. But trying to make a positive out of the situation that's kind of tough right now. But it is interesting, and it comes back to why I take this job so serious. When you're giving people financial advice, that's their money. That's something that they rely on. You try to give them good advice so they can retire early. They can afford to if they're in this situation and maybe they're not doing that well or whatever, hopefully you can provide that. I mean, that's how you take this very, very seriously. And it's a reason why I started Curzio Research, because right now the financial newsletter industry has become a shit show. It's shit right now. You're getting guys that, ex-CIA guy giving you financial advice. You're getting a politician giving you financial advice. Well, I don't think there's any politicians. I mean, was it like 2 presidents, maybe one that had an MBA? They're just not financial anything. But you know what? They could sell, and that's good. And you get these big, crazy promotions. These guys are selling things. And in the meantime, I mean, so many people are getting destroyed. You see that all the time. It's something I take very seriously, even with Michael Alkin, with his daughter. And he came on my podcast. Money Flow Trader, right, under Curzios Research. And this happened to his daughter as well, and it got really bad to the point where he almost lost her. And he told this story. That's why I'm sharing it with you. And it was, it made me think, like, holy cow. And he said, I'm in the hedge fund industry. I want to help people. And when I see a guy like this, who's one of the best short sellers, and seeing a market like this where he says, Frank, it's kind of like shooting fish in a barrel and stuff like that. These are kind of people like I want to try to get in front of you to make you money. This way, when you see markets like this, you're kind of prepared. Because when you're long only, which are my 2 newsletters, and I might come up with a few short positions, you're going to see them get hit in markets like this. But you want to be able to provide people and get those people in front of you that are going to help you make money. But when it comes to family and stuff like that, it's very important. It's why I started this company. It's why I take this job so seriously. Because when I do have losers, that's why I'm always talking about them. I'll come on the podcast because I know I don't take it as an ego thing. I take it like I just gave you a stock, you relied on me, and now you lost money. That's my responsibility. But it always comes back to family for me. When you see things like this, it makes me even want to work harder and do more for not just my family, but families out there. But, but as far as my daughter and the Crohn's disease and things like that, listen, we're learning about this now. This is brand new. I know very little because I have friends that have it. Now I'm starting to realize a lot of other people have it, and they're reaching out to me and talking to me and offered a ton of support, which is fantastic. For me, of course, as a parent, you wish it happened to you instead of your daughter. And she's 7, so it's going to be really tough to deal with early on with her, right? Because it's just so new and she doesn't know. But one of the things I did today was really cool. Right before I came here, I went to her school, and they all wrote cards for her. And going in, like the whole entire school was like, hey, is she okay? As I walked in, and it was really cool. And then when I went to a class, I did a FaceTime video with her from the hospital with all of her entire class, and it was really cool. She was just so happy, and she was showing the IV and this and that. They were all laughing and giggling and having fun and cool like that, But it was pretty awesome. And but for any of you out there that are familiar with this or have this, and if you want to share something like that, feel free to email me, frank@curzioresearch.com. Again, I'm willing to learn, willing to listen. I'd really appreciate that because I feel like I'm always trying to be the one trying to educate, right, and make you smarter investors and do educational segments and stuff like that all the time. But this is one time where I need to get educated, So I would love to, hear your stories. People have had this for a long time, and look, it's not the end of the world. Just something's going to make her uncomfortable and things like that. But learn about this whole process and everything. That's one thing I love about this network because I've been trying to help you guys for a long time. I know sometimes you guys send me emails and things about my personal stories, and your family, I tell you everything, even though my wife gets pissed off at that sometimes. But that's just how I feel since I've been doing this podcast from day one, which is basically over 10 years now. And you guys have been following me, listening to personal stories and all that stuff. So, yeah, I just want to give you guys a up-to-date report, and I will continue to update you again because I consider you guys family. Now, this is an investment podcast. So I got a great interview for you, and it's with Andrew Horowitz. Andrew Horowitz hosts the Disciplined Investor Podcast, and he's the founder and CEO of Horowitz and Company. And look, Andrew is the perfect guy to have on during these markets because his technical levels right now, they're being hit pretty close to breaking through the 200-day moving average. If you want to know what that is, again, a lot of you probably know what it is. It's an important moving average. We broke through the 50 and 100 last time the market corrected, but as soon as we got to 200, the market bounced back. This time it feels a little different, at least to me and to him. And if it breaks that, it means the market come down a little more. So you want to know what to do. Is that a buying opportunity? Is that the time to short more? Which you say, well, I should have shorted to begin. We're talking about technical analysis here, not fundamental. A lot of times you're shorting after you break through these things because it takes another level down. So having Andrew on is going to be fantastic. He's going to tell you about sectors, different stocks he's looking at, not just to buy, but also to short. I'm going to break down a lot of interesting trends. So, I'm fortunate enough with this podcast where I've been in this business for over 20 years. We have great contacts, and I usually get my guests on. I call them last minute. When I say last minute, pretty much within 2 days, 3 days before I tape, where you'll see a lot of podcasts that I go on, they try to book me 2 months in advance, 3 months in advance, and have a whole schedule and plug yourself in the schedule. For me, it doesn't make sense to have, a technical analysis on when it's a, value fundamental market. If we have, something going on with the financials, I like to have Chris Mayer on, who's a former banker. He's a great analyst. If you're seeing a lot of things going on with gold, where we're seeing right now, the dollar's coming down, we're seeing gold get a little stronger. You'll see me put on America to Doug Casey. This way I want to make it up to date and relevant with this podcast, not just throw someone in here that has nothing to do in an industry that didn't, really has no news on it. It's not really going to help you out. So I try to make it as current as possible. And you know what? Let's get to that interview right now. Andrew Horowitz, thanks so much for coming back on my podcast.
Well, thanks for inviting me. And I was wondering if you'd ever have me again after the last time when I told you that my podcast was better than yours.
I don't know. I don't know which one's better. I don't know. We'll let my audience decide.
Yeah.
But we've been doing this, guys. So if you listen to the podcast first time, get a lot of new listeners in every week. But Andrew and I have been doing this for a long time, and we're really close friends. And we discovered the platform a long time ago when nobody really was crazy about, especially on the financial thing. And now it's starting to get really popular. So it's really cool because the more people listen to podcasts, the more people doing them in the financial industry. It's not like competition, right? I mean, you can listen to any time you want. Any day you want, but it's really cool. So let's get to some fun stuff because I'm getting a lot of questions and the market is coming down. People are worried and they compare it to, the credit crisis. And we saw this happen when we had a correction not long ago when it fell 10%, came back right away. To me, that feels different. And I understand the questions I'm getting. What are you seeing as a technical analyst? Because we're hearing things like, we've talked about this offline, like fundamental backdrop is strong, earnings growth is steady, the economy is growing. We're hearing that, but when everybody talks about that, it feels like it's already factored in. What are they missing here?
Yeah, that's a great question because every time you tune into various television shows or some radio shows, it's the same thing over and over and over. The mantra, the talking points are the same, right? As you said, you got a good fundamental backdrop where you have this economy that's growing and you have GDP that just came out at 2.9% revised for the fourth quarter. And, you have a business friendly environment with lower or less regulations. You have this tax cuts that are going to really do a lot of good for corporations and their earnings. We're looking for double digit earnings growth over the next several quarters from a year over year and all these great things, right? And stocks are priced correctly. And, however, they're saying all that. Meanwhile, stuff is crumbling around them. And you have to wonder what's going on. So here's a few things. So I think the first thing that people have to pay attention to is the change in the dynamic of global trade. Now, we could argue back and forth, and you and I have, on whether tariffs are good or bad. The problem is that however you want to slice it, it changes the dynamic of what's going on with global trade. Now, eventually, it could turn out being very good for the U.S., but it's a change from the status quo of what we know. Companies are not quite sure if there's going to be retaliation and what that's going to mean, or if it's going to be just smooth sailing and they're going to be able to have the ability to sell to places that they weren't. Maybe some of the limitations are lifted, like what happened in South Korea on our automobiles. So that stymies the potential for CapEx. That stymies the potential for the understanding of what that forward and outlook is for companies. So that's a change. It's just a change. Then you have an issue with the Fed. The Fed raised rates. They're talking about possibly 2 to 3 more rate hikes this year and moving up rates through to 2019. They're also slowing down and continuing with a lower amount of bond purchases through their quantitative easing program. And this what happens here is that when you have rates rising, you have to look at how valuations are calculated for stocks, how valuations are calculated for bonds, what the comparison is, and the benefit or detraction for each. So when you see interest rates going up, it causes a lot of things to happen. It causes borrowing prices to cost to go up. It potentially limits the amount that you can actually borrow. And when people are doing discount models and using a risk-free factor in determining what the value of a stock is and then looking it out over the future and saying, well, we put an X multiple on that, what happens is as rates go higher, that multiple comes down. So now we have this revaluation that could be going on by analysts and looking at stocks and saying, okay, well, even though there is a better earnings environment, we're going to see possibly a slowdown in the economy and the potential for higher rates, and we're going to have to adjust our outlook. Then you have a tremendous amount of uncertainty. You know, markets don't like uncertainty. So you have a tremendous amount of uncertainty due to headline risk, and a lot of it coming out of Washington, whether it's maybe a shuffle in the White House, a new discussion of tariffs, whether it's a slam on a stock, a direct slam like we saw just today on Amazon, where they were going right after Amazon, whether it's for real reasons or political reasons, doesn't matter, but directly singling out a stock or an industry. And then you have this dollar situation, dollar plunge. I mean, it did rise today after the GDP came out, but this plunge is questionable. Why are, if we have a strong economy and why if things are looking pretty good and rates are going up, is the dollar dropping? And I think it has a lot to do with our lack in the U.S. of fiscal discipline after we just passed that $1.3 trillion bill that nobody read. So there's a lot of things going on that are making people say, wait a minute, let's just sit and regroup for a second here and figure out what we want to do. So that's the answer to those questions that you just asked. Then you have technicals. You know, we've been sliding through a variety of technical levels, blew through the 50 again, blew through the 100, bouncing in the S&P 500 on the 200-day. So we went through the 50, went through the 100. Now we're just sitting on the 200. And the 200-day moving average usually is considered a pretty good point where institutional and hedge fund managers want to look at, well, that's a point that we're going to defend. And we're going to put our money there on a, for either a stock or for an indice. So as it's happening, you got sellers that are dumping, you got buyers that are hitting back, and you're getting all this volatility, 600 points up one day. Then there's people coming in saying, you know what, I don't want to be involved in this. I'm selling. It drops down. Liquidity is very light due to share repurchases and money taken, shares taken out of the markets. So all this stuff is kind of coming together, and in the end, it changes sentiment. So people are confused on what to do.
So let me ask you this, and let's start with the technicals before I get to the fundamentals. With the technicals, you're saying we blew through the 50, by the 100, and we're close to blowing by the 200. Did we blow by the 200 last month when we saw a 10% correction, or did we not blow through that?
For the S&P 500, we stopped like on a dime.
So I would say right now, as someone who's not a technical analyst, I follow technicals, and I think everybody knows 200-day moving averages. Most people do. When we break through that would be a lot different from when we saw it. So that's basically, I mean, we're really, I would say from technical level, we're looking at that level very, very seriously, right?
Yeah,
because
exactly.
Last time it didn't break and it came back. Because we looked at 50, we look at 100, and I've seen us break the 1500 so many times, and it's usually a negative indicator, and it was a buy and a dips. Now, what it's going to be different this time, and I know you don't have a crystal ball, but if we break through that 200, is there a possibility that how would you trade this as a technical guy? Would you say, okay, now it's time to really go short?
You know, the problem is, I just want to pull up a chart here. The problem is that, first of all, we have a 200-day moving average that the slope is on the incline. So that's good. That's a good thing. We're starting to see the S&P 50-day moving average start to roll down a bit, and the 100 is pretty flat. If we roll down past this 50-day moving average, you would see a pretty good flush down a few percent, maybe another 5% or so. That is the line in the sand. That is where that has been protected today again. Every time I got close to that, bounced right back up. And it bounces up with a vengeance, as a matter of fact. I mean, I saw very quickly markets were down 0.5% or so today, and then all of a sudden they just bounced up about 0.25 or 0.3%, then came right back down and bounced. Right now, the 200-day, which is a very simple technical level, but very important for a lot of people, because one thing that happens is there are a lot of strategies that will say, if we're under the 50-day moving average, we're out, possibly going short. If we're then, there's other strategies that say, well, if we are under the 100, we're going to be short. If we're under the 200, we're out for the next 6 months. So that, as an example, there's different strategies, but there are those strategies out there. So therefore, those that want to be long, those bulls that have the money and control things, and the algos know that the 200 is a pretty big number. And if, in fact, we break that, a lot of people are going to possibly just bail out and sit on the sideline for a while. Therefore, you don't have that money coming in until we get a move, and possibly on a month close, because we're right into the month close now. We're into the quarter close as well. That is sustainable above the 200, because they see that as a level that is very supportive for stocks. Once you start going below that, now you're starting to talk a different trend that's going on, and this bull trend that we've seen for some time under the 200s, not very healthy, with one caveat. This market has a way in the last several years of just defying gravity. And we saw that just in February, where we did touch the 50-day moving average on the S&P 500 and it just ramped right back up. The NASDAQ had an all-time new high. The Dow Jones and the S&P did not, and they didn't confirm. But there is a lot of interest in this 200-day moving average, again, and other particular levels. But below that, I don't know if I would short. I would start thinking about slowly but surely, possibly looking for shorter-term trades to possibly look to buy into. But I would be very careful, because don't forget, about 80% of a stock's move can be attributable to the move of the underlying market that it's a part of. So if the NASDAQ is moving pretty hard, probably the stocks inside the NASDAQ, whether it's big or small or one way or name or the other, are going to be following that general trend.
And that's really what we're seeing here, right? I mean, we're looking at a market that really, when it bounced back up, you made a good point. NASDAQ hit a new high, right? When it came out to February, the pullback in February, that 10% pullback. So what was the leader there is you didn't see a lot of stocks really bounce back, but you saw the FANG names really come back strong, which helped the NASDAQ hit the high. Now you're seeing the leadership of this market, especially the past few years, starting to get crushed, right? So, well, Amazon's there now. You have the president coming out against Amazon. Again, he likes to call out different stocks and whatever, individual companies and sometimes industries. But now you're seeing Netflix come down. You're seeing Tesla come down. You're seeing, a lot of these momentum names that as well as I do from a fundamental level, right? I mean, I cover this, it's not about fundamentals a lot of times. And you say, well, that's crazy. Well, it's a lot about momentum. It's about growth. But when I see the level that Facebook has come down, and you have to take into account, they could have to have a change in business model, maybe, right? Maybe, right? But if you look at a company where they expect to grow earnings by 45% next year, and they're trading at 17 times forward earnings, compared to consumer staples that are trading at 20 times earnings and not growing earnings at all. I mean, when does it come to the point from a fundamental level where you say, wow, this is overdone? And again, maybe it's not about fundamentals, but when you look at that from a long-term holder, would you say, if we go down a little bit further, you're going to see lots of buying opportunities, or you think it's, hey, this overall market here really looks toppy because it's been going up, so earnings been supporting that. But it's just interesting, right? I don't know if I'm trying to answer your question or saying it myself. For me, I'm trying to figure out what's good, what's the next step over the next 6 months. Is it going to be another comeback? But we fall into a level where there's a lot of interesting names that people could get into, and it seems like once they get to those levels that they're waiting for, they're like, whoa. I'm not going to touch Facebook now, because it's down. Right. So it's kind of crazy. So I want to get your sentiment on that. Of you invest short term, but the next 6 months, what will be your best guess? And I know you don't have the crystal ball, but for me, it's
I think that, first of all, that 200-day moving average that I told you, and since it's on the incline, and we touched it on, I believe it was February 9th that we touched it and bounced off. The number you have to look at of SPY is 253 and a quarter. 253 and a quarter is like, beyond that, we start seeing a real flush down. So that was the a bit below the flush low of the February market decline. And that's the number you need to be looking at. That's below the 50-day, 200-day moving average, and it's just below and into a whole area that we call it on some of the analytics that we look at as a level that it will see a flush. Now, if we see a flush and a big volume move that accompanies it, everybody's kind of just throwing things out, then that could be a signal to buy. The second point is that we have to question whether or not the fundamentals that we're seeing right now are aligned with technicals. Don't forget, if you're a fundamental investor, that's all you want to look at. If you're a technical investor, that's all you want to look at. But when we blend the two of them, we say, okay, we know things look okay, but something is not right. Now, it could be 100 different things, but something is not right. Is it that the market we know is a forward-looking mechanism, and we can see somebody seeing something in the future, and 6 months is a good time period, something in the future that's just not right, that maybe we're going to peak out on earnings, maybe we're going to peak out on the economy, maybe there's something else brewing somewhere else, maybe with the midterm elections, I don't know, something. And markets are sniffing this out, and that's why we're seeing this kind of move regardless of the fundamentals. And who knows, maybe with what all goes on, the fundamentals will then follow because of it. Follow what I'm saying? So
yeah,
you're kind of in a bit of a jam right here, but I would not try to be a hero at this point.
Yeah, no, I definitely agree with that. It is interesting, though, because even from a fundamental view, you see interest rates going up. Guys, just to give you a little history here. The market on average, dating back to, I think it's 1952, 54, when the S&P 500 became 500 companies, trades around 15.5 times earnings annually. That's the average multiple. However, there's so many different factors, right? Because the average interest rate, if I had to guess, is around, and this is a pretty good guess, around 2.2, 2.5%, right, on a Fed funds rate. Where we've seen interest rates go higher and lower. Again, this is around an average over that time frame. So we're trading at 17 times earnings, and you could argue that 18, 19 times earnings is not expensive if we're growing, right? Because you have to throw in the growth factor. We expect to see double-digit earnings growth, right? So when you're looking at double-digit earnings growth, and you're looking at the PE and throwing in interest rates as well, to me, it still seems like the market is not too expensive, which could be meaningless if it's technicals or whatever. It could come down. But it is kind of interesting. Like the re-rating of where that multiple is supposed to be is very interesting when you think about it. Because if we think we're going to get above 2.5%, maybe we do, then that multiple should come down. You're probably going to see earnings. They're probably more inflated now than they've ever been. Again, we had the tax reform. So a lot of this is not artificial, but it was just thrown in there. Now they're going to save more money. Fine, that's great. But it's interesting on the debt side, too. As interest rates go high, we carry much more debt than we've ever had in the history of this country.
Mm-hmm.
But when you throw all these things in there, I just wanted to show you guys what we're thinking as analysts and just talk about technicals. There's a million things that come in, and we try to get an educated guess and say, hey, is this a buying opportunity or not? This is one time that I've been very aggressive saying buy the dips, buy the dips, buy the dips, where this time I'm kind of on the fence where it just feels like this might not be a buy the dip opportunity.
I think that if the fundamentals and that whole thing that we started this conversation off with doesn't change much, if there is still good growth in the economics domestically and internationally, and the earnings story doesn't change much and all of that, and if we see a major plunge for some reason, I do think there is the opportunity to start dipping your toe in and start picking up positions there, okay? Now, it may not play out right away, and you may get a little bit burnt on the way as it's moving around and it's so volatile, but at the same time, unless we do see a major change in the things that we start with in terms of the economy, in terms of the international situation, in terms of if a trade war does develop or not, or maybe go to war of some way or not, or there's something that's going on, or interest rates spike, there is, I think, a lot of opportunity, yes, to find some great value that would possibly be opportunistic to invest in that you can hold for a while. On the other hand, when we're in the middle of the range, anything can happen. That's where you're trouble. And that's where, all of a sudden you're going to start buying down and buying down and buying down. And then you're going to get blown out. And then the next day it turns around on you. So you got to be careful at the price that you're buying, where the market is. When you see the volatility where it's whipping around up 0.5%, down 0.5%, or you see that one day it's up, the Dow Jones up 650 points. And the next day it's up 200. And then all of a sudden it closes down 350. Something's not right. That's not normal, is it, Frank?
Well, let's get to it. I mean, does this have to do with algorithms, right? Because we see algorithm trading where you look at over the past 10 years, it's grown enormously. Now, you don't have like 2 or 3 of the top funds, high frequency trading algorithms. Again, these guys are interactive stocks at billions of dollars being filtered in and out within, sometimes seconds and minutes, which is crazy. But now there's so many more hedge funds using these strategies, and they're not exactly the same across the board, but they may have a lot of factors within those algorithms when they see things, and a lot of that's technical. And I've noticed even in small caps where, say, if a company reports earnings and it'll open up down 3-4%, and it'll trade there for the first hour, and it'll finish down 15%. And same thing when a stock opens up 3-4%. Again, it just keep flying. It'll be up 20% at the end of the day. And you're looking and say, well, is that short covering? And I'm not seeing huge shorts. Like it doesn't have a huge short position there. So when I see these things, how much does this factor in? Because we're in an environment where we haven't really seen major pullbacks, right? These major corrections all the time. But right now, where we are and how big the market is and how much we've growth and how big algorithm is trading, this is kind of the first time we're seeing a lot of this with volatility. Does a lot have to do with that?
Yeah. Oh, yeah. It has to do with the lack of liquidity in the markets, a lot more players playing it. And then on top of it, what you have is that when these algos are set to the buy mode, just think of it as a switch, right? The algos have three ways to play. They buy, they're neutral, they're selling. When the switch is flipped to buy, what we have is pretty much last year. Every time there's a 20 basis point move in the market, they buy it. They keep it up. They just slowly funnel money in, right? That's what happened all through 2017. Money was just funneling in from a variety of places, not just the algos, but institutions and entities like municipalities and pension plans, all that. So all this was happening. This year, they're either right now in the neutral stance where they're not actively buying, or there are a lot that are in the sell mode where it's, hey, any rally, let's sell it. Any rally, just sell it. So right now, think of it, and very simply, as you're thinking about what's happening with markets, is the algos or the buy mode or whatever you want to call it is right now pretty much in the sell mode. And how long that lasts, you got to think about it. Well, how long did it last that people were putting money into the market, increasing their leverage, increasing their positions, funneling money in? How long does it take to get some of that out to bring that stock allocation down a bit? Now, it can happen very quickly, like we see these giant drops down in just a couple of days, but there's a lot of shares outstanding that people own that maybe they were holding on to for a long time. They're like, you know what, maybe we'll start selling some of this. And you have the algos doing the same, and all of a sudden you start seeing this incredible amount of volatility. And again, when you see the rallies being sold like we've been seeing, and the range of movement on the market's so wide, it is these algos that's a big part of it. And you got to be very careful not to get stuck with them, right in the middle of them. Don't get too excited. Mm-hmm. Don't get too excited when it goes up, and don't get too upset when it goes down. Just kind of try to see where the bigger trend is. Cool.
And I'm glad we went over that segment, guys. We're going to get to fun stuff and stock picks and things like that. It's just, I wanted Andrew to come on. I want to hear what we think when we see a market like this, what we're thinking about. So it's for me, it's analyzing so many different factors, saying, okay, where do we think the market's going, and what sectors would benefit? And then not only what sectors would benefit, what stocks, individual stocks would benefit the most. I mean, there's a lot that goes into our analysis when it's not like a coin flip. So, and let me say this really quick. Once again, we're talking to Andrew Horowitz, host of the Disciplined Investor Podcast, which, like you said earlier, is the second best financial podcast in the world. Yeah. Founder of Horowitz Co., which is asset management. And I want to get to this real quick because I got some more questions. But you actually have a cool product that's gaining traction called Investology that we talk about all the time. And the last two times I had you on, I felt bad that I didn't give you a chance to pitch it. But I like it so much, I want to give you a chance. No, seriously, I wanted to see it because I love it. I only endorse things that I like and that I think people could make money from. And, this is one of the things I didn't mention last time. I was like, I got to mention this. So go for it. Yeah, this is really cool, actually, because what we did was we took the best of robo investing, which I'm not a big fan of, right? But we took some of the components, like the back end. That's some cool stuff they got going on there. The technology that actually drives and runs some of the robo investing process with things like questionnaires that can help you and understand a bit about your risk tolerance and then model a portfolio. We took that kind of and did it in a way that we create it as our own. So there's nothing out of the box here. Everything's been created. All these things we manage. We call it advisor crafted, technology enhanced. Basically, you go over to Investology.com. There's a couple of links there it's ENVETOLOGY, Investology. And you can click on there and just set up a free account and just start answering a bunch of questions. And all of a sudden, a portfolio appears and starts filling up with various sectors that we have allocated according to risk factors. And then from there, it's really easy just to open up an account and fund your account. Then you can monitor it. We monitor it in the back end. We do rebalancing on a systematic basis. So you got no load and commission-free ETFs
that are in the portfolio. We cover all the areas. This is not a trading portfolio. This is more of an asset allocation model, but really cool stuff for the beginner investor, because we start out with a $10,000 minimum. So it's pretty cool. I would definitely recommend checking it out if you haven't checked it out.
Now, in certain ETFs and sectors and things like that, where are you seeing bargains? I know we talked about value over growth and stuff like that, or growth, which growth has been in favor for most of the time over the past 7 years. You could argue with a few spots, but you're starting to see value really come back into play, aren't you?
I am. I mean, I think, and if nothing else, the last 2 weeks has shown some of that. But value, what we're looking at there is that if in fact we are entering into a period where there is the potential for a revaluation of the earnings model, some of these go-go stocks, like we're seeing with Amazon and Netflix and whoever else you want to pick, are starting to see a lot of leakage right now, and those stocks are the most vulnerable, in my opinion at least, to some of the issues that you have with regard to a market that has a change in sentiment. And therefore we're kind of slightly overweighting the value side of things. We're not going directly into value. We still have both sides, but we're picking up more on the value side. And we want to, even though we have a range of very conservative to aggressive in the genre of these models, even the most aggressive is backed off a little bit right now because of what we're seeing. So the other thing is that you still probably want to be into some of the emerging markets right now to a degree. We don't have a real big play in any one sector per se. We take more of a broad-based approach, but like bonds, we do have bonds in the portfolio, but they're really short. We have alternative assets, whereas we have managers that are actually going out and, picking up things like, credit spread type of strategy or macro strategy, or a news-related strategy. So that's inside there as well. So there's a whole host of things that help to balance the portfolio entirely.
And what about individual stuff? Because I know you've come on and you said, CRISPR, you nailed. You had a great pick with that one. And now I know, you talk a little bit about steel a bit as well. Is there individual names that you like, or even individuals that you're shorting? Because I know you're not too crazy about big box retails after the recent run up as well.
Yeah. The big box retail, I think that whole area has been very concerning for some time, and it had a gigantic run. So, we've been short. I'll tell you just a couple things. We've been short Macy's for a while. We closed that position actually today. When I saw that in the face of the last couple of days, it was bouncing off its 50-day moving average, started getting into a zone that I said, we'll wait to reshort it, but I will be actively reshorting that position. Picked up a small position, a starter position of U.S. Steel. On a technical basis, there's a head and shoulder pattern that is developing, which is usually negative. However, unless you're in the development of the pattern. So therefore, if we see that this is a right shoulder and we do see a move up and then eventually roll down, there is the potential for it to move to about $40 from about 33.5. $30.50 is the kind of like, all right, I'm done with this. That's where we go away from this. And one of the things that's interesting is that after the tariffs were put on or taken off, or however you want to look at it, with steel and aluminum, this thing had a nice run, and then all of a sudden there was a kind of a big letdown. But I think that U.S. Steel, if in fact we do see that there's going to be some infrastructure spending, if we see that there's going to be a continuation of the economy doing okay, I think U.S. Steel has an opportunity. So we're talking about 15, 18% upside on that. CRISPR I mentioned. There's either edit or CRISPR. I like CRISPR. As one pick, dropped down pretty much from about, I think it was 58 to about 45. We like that. We originally picked it at 16, sold it, and now just bought it back. Cara Therapeutics, which is a company that does non-opioid painkillers, that some of them are based also on cannabis, but they're really working on inhibitors to your pain senses, if you will. They're working on inhibitors so that you don't have to get on the opioids. And there's a big thing against opioids right now. Credit Suisse, the European bank. European banks look terrible, just absolutely terrible.
Talk about that for a minute, because I think that's a big point. Maybe we could finish off with this, because when we're looking at tariffs, and everyone has different opinions on tariffs, again, for me, I broke it down where 98% of the stuff that you're reading doesn't really understand it, where Yeah, and I had a Steve Kumar, a brilliant guy, came on last week and explained it. Where, they have value-added taxes. And we're getting charged by everybody, right? So who's complaining is the two people that complain the most. Everyone's worried about the trade war because we're the easiest country to trade in, right? It's basically free. Are the European Union, right? Well, I mean, the EU is complaining, right? It's one area, and then you have China. Why? Because they have the biggest by far surpluses in the world of $300+ billion, huge surpluses, right? And now with all this trade stuff going on and people worried, and we're so worried in the U.S., it's interesting to see, because I don't know if you guys saw Deutsche Bank, but I mean, it's collapsing right now. I mean, these guys want to have a trade war where it is going to significantly crush them, much more than it crushes us. Where I think it's more talk now, and I don't think it's that big of a deal, but it is interesting to see how a lot of those European banks are really starting to get crushed now. Yeah,
I mean, we picked up Credit Suisse on a couple different reasons. Concern about the European banks and the potential for the ECB to start, running off and slowing down on their bond purchases, which has basically been holding all these banks up that have a lot of problems. These banks also, by the way, are notoriously bad actors. Notoriously. Credit Suisse recently was part of this thing where they had probably, I don't know how much of a loss it was. They had this one fund that was short volatility that blew up on them back in February. And there's probably going to be a lot of lawsuits, we figure, class action lawsuits, and there's going to be some losses. They're saying, we're not going to lose anything. That's not what we understand. We saw that there was actually a piece that they lost on this that was pretty significant. So, on that, and the potential for some lawsuits, and add to that some of the weakness we're seeing in the European banks, I think that this is an interesting play on to look at on the banking side, to be on the short side of it. So.
No, it's really cool because I love having you on, because we're going like so many different areas, talk about so many different markets. And guys, if you get a little confused or anything, listen to it again. I mean, it's very easy to listen to and hear the points. Whether you agree with them or not, it's not so much, well, you got to agree with everything what Andrew says and what Frank says, but putting those ideas and learning and just listening to a certain amount of people and just having different opinions from yours is always a good thing. So with us, we're just trying to figure things out. There's a lot of moving parts right now, and we want to see where the next move in the market's going to be, because right now it is at key levels, which early, right?
Yep. And I think, like I said, if anything you take away from this discussion, it's that it's not time to be a hero. It's not time to lever up. I mean, it may become time, but it's just not there yet. You want to see things settle out a little bit. You don't
Sentiment's still high. Sentiment is extremely high.
Sentiment is high. Yeah, but that's also a problem, because people think they're invincible. A lot of people that have that high sentiment, you know what though, Frank? They've never been through a downturn.
No, but that adds to your thesis too, right?
Yeah.
That's usually used as a contrarian indicator. You usually like to see everyone hate the market. Right now, people are still kind of like, that sentiment's still high, where they're not really worried right now.
Right. You can't find anybody on TV that's negative, but that's standard. But at the same time, I think that you have to realize that it's going to take a lot after 9 years of learning that you buy every dip and you make money on it. It's going to take a lot to spook people out. But when they do, it's going to get ugly. You want to wait for that ugly, the old blood in the streets. When you are so panicked that you don't want to buy stocks under any circumstance, I'm not talking about nervous. I'm talking about like freaking out, panicked, sweating, not sleeping, not eating, which none of those things seem to, unfortunately, affect me, especially the eating part. I could be out of my mind. I'm like, give me a sandwich, I'll feel better. But, but truthfully, seriously, you want to be at the point where things are looking so bad and people are coming up to you, go, oh my God, what am I going to do? When people start talking about this, they start freaking out. I'm out of the market. I'm never getting back in. That's when you hit it. That's when maybe it's time to be a hero at that point and hold on really tight. Until then, we're caught in the middle of something that's going on here that, if you want to build small positions and things that are really strong and solid, that's fine. But, trying to grab a falling knife or trying to be a hero in this by levering up, just can be very disastrous.
That definitely makes sense. And speaking of E, I want to thank you for coming on this podcast, because it was late notice, which I explained in the beginning of why, for personal reasons. But you did say I could do it at 2 p.m. because you had a lunch, and you told me what you did for lunch, because we're doing this, around 2:30 Indian buffet.
Indian buffet. God. Delicious.
I'm glad you mute your microphone when you're not talking. That's all I'm saying.
Oh, yeah. Yeah, my son always says that when he goes to Indian buffets, he needs a 2-hour nap afterwards.
But either way, bud, I really appreciate you coming on short notice.
Hey, my pleasure. And best to your, best to your family. Take care of things. And, I'm here for you. I look forward to seeing you soon.
Talk soon. All right, great stuff from Andrew. Like I said, I always like to have guests on that are timely. This one, because I told you at the opening, I've been in and out of hospital and stuff like that, where Andrew and I have this long, it's not even a written agreement. It's just nothing, but this is just the way we are because we're doing podcasts for so long that if he ever needs me last minute or I need him last minute, we automatically go on. And not only was it a perfect market for him to come on, it's nice to go to someone that you can rely on and a friend and be like, hey, you know what, not only do I need you for my investors and stuff like that, but I kind of need you for me because it's been crazy. And, I haven't had the chance to really talk to anybody, do anything business-wise the past couple of days. Now everything's great. My daughter should be coming home tomorrow because everything was good today, and they say she'll be coming home tomorrow, which is really good. And, I don't want to end this sour note here. It's pretty cool. Again, everybody has problems a lot worse than this. And it's something that we deal with. It's going to make us stronger and things like that. But, again, I wanted to share it with you because there's also something else important, right? Kansas Jayhawks making the Final Four, which I didn't have, right? Updating you guys on that, where they're going to play Villanova. And look, I know you guys have been following me. Still ask questions about the Final Four, and I'll close with this really quick, and we'll go back to educational segments going forward. But KU Villanova, man, KU making it this far is incredible. I just thought Duke was a much better team. It's amazing how just a shot that hit the rim 5 times at the buzzer falls out, how different you look at the game afterwards, because now you're looking at, wow, Duke wasn't that good, or they made so many mistakes, and if it fell, you would have talked about all the mistakes Kansas made. But I just think that you have Newman playing at an incredible level right now, which he was supposed to be playing at this level for the last 2 years when he was in Mississippi State, transferred over to Kansas. Now he's incredible, best player in the tournament by far right now. But Villanova does not have any weaknesses. I mean, they shot terrible last game, one of their worst shooting performances, and they still won by 11 against a great Texas Tech team. Texas Tech didn't play that good either. It's going to take a lot for KU to beat Villanova. They can, of course. I want them to. They're my favorite team in the world. It's going to be great. But Villanova, really, I mean, they have no weaknesses. They have 6 guys that are scoring, averaging 10 points a game. Very diverse. They hit threes like crazy, and they also have an inside game. They play pretty good defense, one of the highest scoring teams. I think Kansas keep up with them with points. It's just, they're not the best defensive team, and I see them give up a lot of threes. So we're going to need some help from Villanova. On the other side, Loyola Chicago against Michigan. Loyola Chicago has been amazing. Look at Michigan, Wagner. I mean, awesome. You didn't know what Michigan was going to do because they were really one that good this year, won the conference tournament. Now in the Final Four against a team that I think they're going to beat. Not taking away against Loyola Chicago. I just think they don't match up well to Michigan. And I can tell you, everyone in the world is picking either Villanova, and some people are finally picking Kansas, which is interesting. No one's picking Michigan at all. And that's going to be a motivational factor because I think Michigan could match up to Villanova pretty good. And also Kansas. And it's not going to be an easy win for any of those teams, even though that side is obviously weaker with Loyola. But it's a cool Final Four. If they're all said and done, you have an 11 seed, which is a surprise. But 2 1 seeds. What was Michigan, a 3 seed? But that conference champion. So not too much of a surprise. Just really early on, a lot of teams lost. Should be interesting. But Villanova by far is the best team. And you're going to need help from Villanova in order to beat them. They have to play a terrible game or something's got to go wrong. Or Jay Wright has to make a terrible coaching mistake. But it should be very interesting Saturday. And I appreciate all the questions I get about the Final Four. One last note here, guys. We're changing the schedule, not big, but just a little bit, of the podcasts that I do. So this one, I'm frankly speaking. So we have Wall Street Unplugged. Instead of publishing it on Wednesday night, because sometimes it goes out 6, 7, 8, depending on whatever, we want to have this on a set schedule. So we're just going to publish it at 6 a.m. Thursday morning. This way you can listen to it on your commute. This way we know we can publish it no matter what. 6 a.m. is very easy because sometimes publishing is rushed on Wednesday because there's a lot of things going on. A lot goes into publishing these podcasts. And also for frankly speaking, instead of doing it on Friday, we're going to start doing it's going to be available on Monday morning at 6 a.m. Okay, so I'll make sure I do one on Friday and also on Monday. So I'll do an extra one for you guys. This way no one's confused. I'll let everybody know. But that's going to be our schedule because we want to have a set schedule because we just hired a podcast manager and we're really going to try to scale the podcast, get it out to more people, and really start marketing this thing. And just trying to help a lot of investors out there with educational segments, getting the best guys out there, interviewing all over the world on there in front of them that they can listen to for 20, 30 minutes without being interrupted 100 times when they do these interviews on TV, which is terrible, right? The anchors, they just, they had a great guest on for 2 minutes and they talk for a minute and a half. We don't want to hear from you. We hear from you the whole entire segment that you're doing. Whatever it is, whatever show it is. You guys know what financial programs I'm talking about. There's a chance for you to listen to really great guests for 20, 30 minutes, interesting interviews. I think it was pretty cool because my interview with Andrew today was like, if I called him on the phone and talked to him, we're talking about the markets. What do we think is going to happen? And I always want that to translate into, hey, this is what we're hearing. This is what the experts are hearing that follow the market for over 20 years. And here it is for you, absolutely for free. This way I can help you out. So that's the point of this podcast, building this network. I want to continue to build it. And do that. We've got to spend a little bit of money, get some professionals in here. I want to do this the right way. So we're keeping things on schedule. That's going to be the new schedule. Right? So Thursday morning, 6 a.m. for Wall Street Unplugged. And it's 6 a.m. Monday morning for Frankly Speaking. It's going to be a new schedule. If you have any questions, comments, feel free to email me, frank@curzioresearch.com. That's frank@curzioresearch.com. Okay, so that's it for me. Thanks so much for listening. I love you guys. I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.